how might this manipulation by the banks end? It won't. What will end, likely, is when, and I think it's a when, not if, when gold and silver begin to enjoy the same level of public prominence they did in the 1970s, I think what you'll likely see is banks in the long end of the forward paper trade go into overnight markets and buy physical gold and silver to increase the price and to cash out their futures positions from a long point of view. In other words, the manipulation will continue, but the direction will change.
Market manipulation significantly impacts silver prices, often resulting in an undervaluation of this precious metal. Financial institutions and banks have been accused of artificially suppressing silver prices to safeguard their broader financial interests, distorting market dynamics. As global demand for silver continues to surge, particularly from Eastern markets, maintaining such price suppression becomes increasingly challenging. Silver prices could dramatically surge when market forces eventually realign, reflecting their true value. According to legendary investor Rick Rule, short-term manipulation is evident in gold and silver markets. One clear indication of this manipulation is the large-scale sale of physical silver during periods of low liquidity, deliberately driving prices down. In the futures market, the volume of transactions often exceeds the available physical silver, suggesting manipulative actions by major trading desks. These desks may establish short positions in the futures market, borrow silver, and sell it in the physical market to depress prices. Rick also asserts that historically, precious metals markets have experienced upward manipulation. Banks typically manipulate markets in the direction that suits them best. The ongoing manipulation of gold and silver prices is likely to persist, but the direction of this manipulation could shift. If gold and silver regain the prominence they held in the 1970s, banks might begin acquiring physical metals to drive prices up, thereby profiting from long futures positions. Hence, while manipulation will continue, its direction may change over time. Silver has demonstrated resilience, despite manipulation challenges, by maintaining support at its upward trending 50-day moving average. July, silver futures recently traded at $29.235 per ounce, down 0.86% for the day. While gold is a traditional safe haven asset, Bank of America sees silver gaining traction in the precious metals sector. However, silver has lagged due to weak industrial demand. A global economic recovery could boost its performance, potentially pushing prices higher to $30 per ounce. We will present clips from Rick Rule's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
That all financial markets are manipulated in the short term. I have been in financial markets now for 15 years, and I've watched all manner of markets subject to manipulation by traders, which is to say short-term manipulation. If those desks can manipulate markets as big as the U.S. Treasury market, which, by the way, they've been convicted of, or the LIBOR market, the London Interbank Eurodollar market, certainly they can manipulate the gold and silver prices. What I don't agree with is any concept that there has been a 4-decade-long conspiracy to lower the price of silver systematically over time, be it the Trilateral Commission, all those types of people. The evidence that there's short-term manipulation is pretty easy to find. You observe trading over a 24-hour period. When somebody sells a big lot of physical silver during a period in time when liquidity on the market is its tightest. In other words, they try to receive the least compensation they possibly can for selling the silver. It's very obvious if you understand the structure of the silver market, where in the futures market, often 100 times the silver available for good delivery transacts in one day. If you look then at the ladder of transactions going out as far as 2 years, what you come to understand is that it's possible for big trading desks or even coalitions of trading desks to fashion a short position in the futures market, borrow silver, and use that silver to sell in the physical market, hoping that the downdraft in the physical market will lower the quotes in the futures markets, and you can cover a $1 billion short position with $50 million in borrowed silver. Now, this happens in all kinds of markets. It's happened in the over-the-counter market among the wholesale market makers literally for decades. It happens in the U.S. Treasury futures markets. As I said before, it happens in the LIBOR market and the Euro market. Why wouldn't it happen in the silver market? Unknown caller. I remember because of my age, pardon me for this. I remember because of my age when physical markets in precious metals were manipulated up, not down. The banks manipulate things in the easiest direction to manipulate. Now, how might this manipulation by the banks end? It won't. What will end, likely, is when, and I think it's a when, not if, when gold and silver begin to enjoy the same level of public prominence they did in the 1970s, I think what you'll likely see is banks in the long end of the forward paper trade go into overnight markets and buy physical gold and silver to increase the price and to cash out their futures positions from a long point of view. In other words, the manipulation will continue, but the direction will change.
In the ongoing battle against inflation, the Federal Reserve has aggressively raised interest rates 11 times over the past 2 years, marking the swiftest rate hike in 4 decades. Despite these efforts, the economy, disrupted by the pandemic, has defied conventional expectations. Unexpectedly, inflation declined nonetheless, now running at an annual rate of 3.3% after peaking above 9% in mid-2022. This drop resulted from improvements in previously disrupted supply chains and a growing workforce, factors beyond the Federal Reserve's direct influence. Rick Rule highlights concerns about the accuracy of official inflation metrics like the Consumer Price Index, CPI, which may understate true purchasing power erosion. When factoring in overlooked expenses such as taxes, food, and fuel, the actual decline in the US dollar's buying power could be closer to 7.5% to 8% annually. This erosion outpaces the yield on 10-year Treasury bonds, currently at about 4.3%. Rick suggests that as Americans recognize the diminishing value of assets tied to low-yield government bonds like Treasuries, they may reconsider their investment strategies. Historically, precious metals have represented less than 0.5% of total U.S. savings and investments, far below the average of 2% over the past 4 decades. A potential return to this historical norm could drive substantial demand for precious metals, given their traditional role as safeguards against inflation and currency devaluation. Now, let's get back to the interview.
If you look at gold trends over 50 years, they trade conversely to confidence in other forms of fiat savings instrument, in perhaps the U.S. 10-year Treasury. I would suggest to your listeners, Roger, that we've come off 40 years of the most benign economic climate in human history, the period 1982 to 2022. I would suggest, too, that that benign period has ended. I'm not suggesting that we're going to run into, the horrors of the apocalypse anytime soon. But I think that investor and saver and voter expectations, frankly, were shaped by 40 years, of very benign economic climate. And I think that the lessons about the changing circumstance that we're in are reminiscent of the period 1967 to 1972. I think we're in precisely the circumstance now. We've come off 40 years of benign economic climate. People are still, at least people with money, very, very, very bullish. Their appreciation of inflation comes from looking at the Consumer Price Index, which I would posit has no relation to inflation. If you pay attention to that number, you are lulled into believing that the deterioration of the purchasing power of your savings is proceeding at 2.6 or 2.7%. Not pleasant, but certainly if you're receiving 4.3% on a 10-year Treasury, affordable. If then you add back other measures of inflation, say tax, the largest household expense faced by most Americans, or heaven forbid, food and fuel, if you elect to eat or drive, numbers left out of core inflation. What I think you learn is that the real deterioration in the purchasing power of the US dollar is closer to 7.5 or 8%. If you juxtapose that number over the risk-free rate of return that you get in savings instruments, 4.3, suddenly you realize that your salary and that your savings are leading to you being 3 or 3.5% less wealthy every year for 10 years. There's nothing that I think over time will cause people to be concerned about the efficacy of treasury bond investment than a government guarantee that you will lose 3% a year for 10 years. And I think when that realization hits Americans, like it did after 5 years in the decade of the 70s, that you will see a very different appreciation of gold relative to treasuries. I think too, and I think this may help your listeners develop a longer term perspective, the current market share of precious metals and precious metals related investments relative to all savings and investment assets classes in the US economy is less than 0.5%, which means that, historically, precious metals are very, very, very underrepresented as a savings and asset class. If you look back over the last 40 years, the mean market share of precious metals and precious metals related investments has been 2%. If appreciation measured by market share just reverts to mean, demand for precious metals and precious metals related investments rises fourfold. And remember, prices are set on the margin. So I think a combination of those two facts, the fact that we have no appreciation for inflation because we've come off 40 very benign years, coupled with the related fact that the market share of precious metals is at 4-decade lows, suggests that people who don't save and invest in precious metals, at least to the extent of 2%, and better yet, 4% of their net worth, are people who are not good either at history or math.
If gold and silver price manipulation continues unabated, the repercussions could be profound for both markets and investors. Continued manipulation threatens to distort market dynamics, leading to prices that may not accurately reflect supply and demand fundamentals or investor sentiment. Share your thoughts on Rick's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.